Hello and welcome to Crux Investor. We spoke earlier today to Teo Dechev. She is the CEO of Mondoro Capital. And if you want to get our thoughts and opinions on that conversation and indeed the company itself, you can find that at cruxinvestor.com/club, where you can also find detailed company reports, summaries from experts from around the world on a variety of commodities and companies. There are training videos on there. There's also summaries of other interviews that we have done just to save you a bit of time. And of course, there's a thriving community of investors sharing their thoughts and ideas with each other. So go along there now and join them at cruxinvestor.com/club. Of course, we'd love your thoughts too. So do give us a like, leave your comments below. And if you want to see what we talked about, take a look in the description. Teo, how are you doing?
Good, thank you.
Well, thanks for joining us. Where in the world are you?
I'm in Vancouver. It is Friday morning and it's not raining, so that's wonderful for Vancouver.
Fantastic. Whereabouts in Vancouver? Because I know
on
it.
the North Shore.
North Shore. Oh,
Yep.
that's the nice bit.
Well, it's the cloudy bit. That's where all the clouds stop and the rain never seems to end.
Okay, well, thanks for joining us. I appreciate it. And it's early in the morning. And it's early in the morning, and I understand it's not even your first interview of the day, so that's good going, right? Well done, you. Okay, we're going to talk about Mondoro today. We've not spoken to Mondoro. This is the first time we've done an interview together, so I'm looking forward to it. But before we start off, can you give us a 1-minute overview of the business? Then I'll pick it up from there.
Sure. The easy way to describe the company is we really strive for that, let's call it royalty generator model, where we are exploring in Eastern Europe. We do believe in order to make a discovery, you have to really leverage what you know and the capital that you have. And so we leverage that with partnerships. And those partners are the sole funders of a lot of our exploration programs. And as a result, really the back end optionality for the Mondoro shareholders is those lucrative royalties. And because we focus on very large systems, those royalties can become very lucrative because they are on really large scale assets. And most of our assets are focused on copper and gold. You kind of can't really get these systems without both commodities. So when you're looking at the porphyry and the related epithermal systems, they really do have both a copper and gold component. And nowadays, a lot of what we're focused on is really the copper side.
Okay, fantastic. Well, the company's been around a while. How long have you been there?
Since 2006.
2006. Okay, so you've been with the company a while. It's fair to say it's had its ups and downs. When you joined, you had to sort a few things out before you were able to focus on Eastern Europe. I think we'll park that and focus on Eastern Europe if we may. I'm looking at share price. I'm going to say fairly flat for the last 3 or so years. There's a few peaks in there, but we're kind of back where we were, 3 years ago. So what are people not understanding about your business? Because its market cap says here 12.5 million Canadian dollars. That's not even real money, right? That's Canadian dollars.
Yeah, so, most houses in Vancouver are more than that. So.
Right. So what's happening? What do you think the problem is?
It's a really good question. And it's interesting that you frame that also as a problem. There's a lot of junior equities in the marketplace. There's probably 1,600 junior companies. We all want to have a $1 billion market capitalization. And the real question is, how are you going to get there? And what's it going to cost your shareholder base in terms of dilution? So yes, we're trading at 12.5 million. We've been pretty steady, unfortunately, in terms of the upside of the stock today. But we also haven't been, we also haven't lost 90% of our value in the last few years. So I think the downside protection is very good. That's because we run the company extremely well. We're one of the lowest G&As in the business. On top of that, we spend about $4 million a year on exploration. So I think you also kind of have to ask yourself, what is it that you want out of your equity? Of course, everybody wants a 10 bagger, but how are you going to get that 10 bagger? What are you prepared to take in terms of dilution in order to get there? So we're being very thoughtful about that. We don't want to dilute our shareholders out of their future discovery in this region. So we've been really focused on getting our partners involved, or getting partners involved in the projects. They are the sole funders of the programs. And that's why the name, the generator model. And the generator model over time has a very powerful effect. If you can generate valuable assets within your portfolio, then over time, they actually can create a lot of value through incremental steps. And I was, mentioning this before. I used to be in equity research. One of the companies I first covered was Royal Gold back in 1999. And I remember running the DCF and thinking, wow, they've got like a 0.25% royalty on this project. It's, $300,000 here, $400,000 there. How is this going to generate a lot of value? DCF models after 10 years, you might as well forget about that future back end. But that's the mistake, right? Because those models over time are extremely lucrative. And as you build more assets in those layers, they, just become profit-making machines, for lack of a better description, almost an annuity business over the long term. So what we're trying to do is create that stable group of royalties on a district that has got so much potential for a discovery, so that over time, those royalties will become extremely lucrative.
The reason I position it as a problem is I get the downside protection position. That's a great thing to say. But I'm here as an investor, retail investors, for growth. I make money when the shares go up in price and I cash them in. That's how I make money, okay? And it's been a long time. So the question I want to ask is, do you think you've employed the right model? You've been there since 2006. Have you employed the right model for retail investors to get involved with here? Because I've got to see where the upside is, or at least when the upside is coming.
Yeah. If you're going to be running a business where you're testing targets, you have to be running the generator model where you have partners involved. I don't think that the retail market supports that kind of long-term, long-haul investment cycle. That's not the retail market. So if you're in early stage exploration where you're testing targets and trying to create a new discovery, fundamentally that's a partner generator model. So absolutely, it's the right model. But is it the right model for a retail investor that wants to invest based on a drill hole? No, because not every drill hole is going to work out in a target testing type of environment. Having said that, if a retail investor is interested in, a program where they can see, immediate results in terms of what's the next section of that mineralized zone, then traditionally the retail speculator market is involved in established resources where a company is trying to create a larger resource or develop that resource into an economic, let's call it feasibility. That's not what we do.
Okay.
When you go to a conference and people ask you, where's that next discovery going to come in our business? That's what we're here for, to create that next discovery. So if you buy in at this, yes, you call it downside protection and, steady Eddie, and that's the opportunity. You can park money there, and when a discovery is made, that's your 10 bagger. You've gotten very low cost of capital in, and you can make a tremendous return because that discovery will immediately pay because the dilution doesn't occur the way it normally does in an exploration model.
Okay, so that quite nicely describes the type of person who might be interested in your project. Good, I like that. Let's break down the royalty generator description, okay? Because people understand royalty companies, they understand project generators, but you're climbing those things together. So let's see what that looks like. So you're bringing in partners. Why? So what's the conversation with the partner? Is it just for money? Are you operating it? Are they operating it? What are the terms?
Yeah, that's a really good question. There is no plain vanilla approach. And we really want to see capital spent on the projects. So we kind of listen to what our partners are asking for, and we fine tune a lot of our agreements. So let's just start with the royalty business. So I used to cover royalty companies, and I've seen a lot of prospect generators. I have a comp model, which I'm obsessed with data, of 56 companies. So traditional royalty companies buy royalties. Or let's mash them in as well as the streams. You're basically creating a future cash payment. They need to compete based on their balance sheet. Yes, you can try and be clever in terms of, let's say, intellectual knowledge within your team to try and understand if there's a better return on this asset than what somebody else might see. But at the end of the day, at the high end, where on average, I like to delineate this group in terms of the senior royalty companies. Anybody that's making 10 million a year and more consistently on a 3-year run rate, that's the seniors. Those are the only ones that are cash flow positive in the business. So then you go on to the next, let's call it tier. And again, it's really important when you're looking at an industry space to try and compare them apples to apples. And unfortunately, because you don't have that EBITDA and that cash flow on the other side of the business, we kind of look at the top end revenue side. So if you're making between 10 and 1 million top line revenue from your portfolio per year for the last 3-year run rate, that's kind of the mid-tiers. Those companies have grown significantly in terms of valuation, but they're still not cash flow positive. So it's partially a balance sheet, and it's partially hunting through, your own network and your own kind of contacts in terms of what assets you can get into. They fund a lot of development so that, in the future, those royalties will pay out. So let's remember that. In the future, those royalties will pay out. As you and I know, and everybody in the business knows, not every single asset makes it into production at the timeline needed, but that's part of the risk in the model. And then you get into the last end. And the last end is really the what I call the generators. Now, some generators works for different reasons, but our view is we're here in order to secure that future royalty. So rather than me wait for Vale one day to have a copper mine that they want to potentially go out and sell a royalty to, the seniors for, let's say, $500 million, I'm here 10 years in advance, and I'm creating that future royalty that one day one of the seniors will want. So at the back end, we kind of look at, there's a lot of companies. So we kind of say, okay, if you can do 100,000 a year up to $1 million, you're in the junior space on a 3-year average, right? Just always remember the 3-year average, because, this business can be lumpy in terms of top line. So what we like to say is, look, Mondoro's a junior generator for the royalty. So our belief is that in 10 years, one of our assets will become the value of a potential future Franco, or let's call it Royal Gold style asset, because the partners that we deal with have big scale requirements. And as a result, a discovery on one of those kind of projects would create a very valuable royalty. So that's kind of the way I look at the royalty space. I can give you lots of metrics on how they perform, but we actually do extremely well compared to our peers. We've been growing our top line at 56% versus, peers at 10. We're at one of the bottom in terms of G&A. And, we've been generating basically around 350,000 a year, whereas a lot of the peers on average are generating around 200.
But that's going into running the company. That money that you are generating, I appreciate it's less dilutory for shareholders. You're not having to go out and raise capital all the time. So that's good news. But you've got to take that cash and convert it into real value, and in a timely fashion. So I know you're saying to me, some point down the line, this is valuable. And if I'm okay with that, if I want to sit in this for 5 or plus years, that's good. That's the kind of shareholder you want, right? But how do you, and it comes back to the question about, have you got the business model entirely right? Shouldn't there be some shorter term wins that you should be looking at? And if so, what could they be?
Shorter term wins are building out the portfolio. So what else are we adding to the portfolio that will continue running this model? So yes, we don't talk about our application pipeline because that's our competition in the business. But yes, every single year we are going out, we are putting in applications, we are building out our portfolio, and that creates more opportunities for partnerships. In terms of, what is that short-term win? It's bringing in key assets like that in the portfolio. That's number one. And number two is every year there is a drill program on our projects. It's paid by our partners, but there are drill programs every year. So if a investor is really interested in terms of those short-term wins, well, pay attention to those programs. What's going to come out of them? You never know when the next discovery can occur from one of these programs.
Okay. More questions because I'm trying to piece all the moving parts. There are a lot of moving parts, surprisingly, in this. Okay, so you're going out and finding more projects. So again, future value, but the market's not giving you credit for that today. I don't know how to value that today. Okay, so we've got that time issue again. I can see that you would spend a lot of time going out and trying to find partners who can put money in the company to, make things easier for you or allow you to operate or cover your G&A, however you want to charge fees on that. So explain again that relationship. How many partners have you got? Who are they? Have there been any successes? And when do things actually get moving? Because I'm not quite sure how long partners have been drilling for or exploring for or creating value for you, so that you could maybe in no short order can actually talk to the market and say, well, hey, look, I think this potentially is going to be a much better relationship. This project, we know a lot more about it now. I can put a value to that. Currently, I can't.
Yeah. So in terms of partners today, we've got JOGMEC as one of our partners, and we have a partnership with them in Serbia on one project called Borsko, which is actually a tremendously interesting opportunity. It is directly west of the main Bor mines, which have been in production for 100 years. And that project has created a technical success in the sense that we have discovered through what we call a blind discovery in the industry, because it's under 500 meters of andesite cover. It was discovered through structural interpretation and geophysics, and that's kind of like when you say what are those short-term wins. I mean, that's a huge win because now we know exactly where to continue drilling. That target has become more lucrative, more valuable. So that's one partnership. The next one that we have is with Vale. Vale is in 4 of the projects that we have in Serbia. And just recently we announced that they are also picking up an additional 2. And those are 2 projects that were previously with Freeport. And again, here's another example. Freeport spent 3.2 million US, let's call that 4 million Canadian, in a matter of 18 months. And due to internal, requirements, had to drop their global exploration program, which was a real shame because they added a huge amount of value to those assets. To do that amount of geophysics that we did on those programs took about close to 12 months out of those 18 months. And on top of that, did 9,000 meters of drilling, proved the concepts, and now somebody else is going to benefit from that work. It's not that when a partner leaves, an asset becomes less valuable. It actually builds a tremendous amount of data that our shareholders didn't pay for. You just got that all for free. And now Vale is coming on board. They're paying the company these near-term, year-to-year payments. And that's the front end of our business that I was alluding to earlier. That is also a win for us. So again, it maintains dilution, but it's an extremely important part of the business. So I don't want to, unemphasize that. So those 2 partners are working with us. So now Vale's got 6 projects. JOGMEC's got 1 in Serbia with us. On top of that, we have a strategic alliance with JOGMEC in Bulgaria, which has produced some tremendously interesting projects that are now under application. So those are all future opportunities for our shareholders.
Okay. It all just sounds like I've got to wait a long time for this. But before I sort of even go there, what do you mean by technical success? Technical success, when I hear that phrase, I go, there's no economic success, but maybe there's a little bit more information about what's under the ground, which may tell me if I do a lot more drilling, what may be down the line. So technical success doesn't really kind of work for me. So why are you excited about? Why would you use that phrase?
Yeah, it's a really good question. It's a technical success because we actually found an intact lithocap 500 meters undercover based on geophysics. And as anyone will tell you, geophysics is important, but it's really hard to justify a drill program on just, a geophysical target. You usually want other indicators like geochemistry or other structural interpretation or maybe a historical hole. So the technical success, we found the lithocap, and where you find, the thing is though, if you don't have a lithocap, you're not going to find the porphyry system. So it's really, really difficult in the porphyry world to drill right in the heart of the porphyry on the first drill hole and say, yeah, I got a porphyry mine. That's just, that's fantasy. That doesn't happen. So you start with technical success and then you build on that data in order to get to the economic success.
Okay, you're hunting porphyries. I get it. It's hard, but how long has JOGMEC been at it with you? In fact, how long has Vale been at it with you?
So Vale's just started. They signed the option agreement with us last year, or the earn-in agreement. The licenses have now finally been transitioned into the joint venture structure, and we just started the program this year. So the idea is to be out drilling in December. So it has actually been a very short relationship so far with Vale, and we're just starting that process. And we've got a lot of really interesting targets to drill out for this winter season, as well as transitioning into 2021. JOGMEC has been with us since 2016. They have, so that's just right about 4 years. We obviously didn't do a lot of work this last year on that particular project, but what we have been doing is a lot of reinterpretation of the data. So what you always want is you start with your concept, you spend money in order to drill out or test your concept, and then you measure and adjust. You reinterpret, you rerun your geophysical models to ensure that, are you seeing the right correlation? And then you plan for your next program. And that's really what we're trying to achieve now with JOGMEC, is to determine the financing the next program in order to continue testing that target.
Right. Okay. And do you feel that's moving at the right pace for you? Because obviously they're a big company. They've got lots of targets, got lots of optionality around the world. You're not, number one or only one. There's lots of companies out there. So how do you get them to pay attention and focus in on what you want them to do in timely fashion?
Yeah, it's a really good question. And I think if a company was relying on only one partner, that would be a problem. You can't make a major company jump to your tune. That's not how the business works. They sole fund, they decide where things are going to get tested. So what you can do to manage that risk is have a portfolio approach, have more than one project, have more than one partner, fully recognizing at the start of every year that one partner is moving forward while another one is thinking. And that is how we manage risk, and that is how we constantly have activity in our
I get it.
company.
Okay, so we got Vale, who are just really kind of kicking things off this year, okay? The relationship from last year. Freeport have been in, gone, global change of direction, strategy, gone. JOGMEC, been there for 4 years. They'll move at the pace. Who else have you got in there? Who else have you had in there? Because it feels to me like you've got to spend a lot of, you've got your land package. You've got to spend a lot of time chasing down, what do you call them, partners, strategic partners, who in one way, shape or form put money into the company, and they will at their own pace run this exploration program, which can take time. It always takes time, okay? I'm just, but it's not moving at the pace necessarily that you or your shareholders want, but you can't do much about it. So I'm trying to get a sort of sight as to how many of these, how big your portfolio of partner companies needs to be to kind of allow you to kind of hit your stride. Or when you do hit your stride, even if you say it's not going to be for, 7 years, fine. But I tell you, when we go, it's a hockey stick. Lovely. What's the thinking there? How do you drive that?
So like I alluded to earlier, we do have a portfolio approach. We do have other projects in the portfolio, and we are currently in active discussions with other third parties about those other projects. So we do anticipate bringing more partners on board. Last year we had 3. This year we have 2, and I'm quite confident that we can bring in another partner. There are some, and on top of that, we've got the strategic alliance with JOGMEC in Bulgaria, which is, again, 3 other applications. I think what would be, and I do this analysis, and, I'd love somebody else to do the analysis as well. But I think what you're asking is, on average, if a typical exploration company, how much drilling do they do on their project? So last year, we did about 18,000 meters. That's a lot of drilling for a junior. You're saying, well, it's not really going fast enough to you. I want things to go faster. Do you really think you can do target testing at a more aggressive pace? Our team is probably one of the biggest in Eastern Europe. So we've got about 15, 20 people, depending on field season, working for us on a regular basis, running all these programs for our partners. It is fascinating to hear on the outside people saying things aren't moving fast enough. when inside the company, things are going at breakneck speed. You are just constantly go, go, go with all of the field teams, creating the data sets, creating that next project. But unfortunately, on the outside, people are interested in when's that next discovery coming? And what we say is, we're drilling again this year. Take a look at what we're doing. If the next discovery happens on the next drill hole, we're all going to be happy. And if it doesn't, don't worry. There's 25 other targets to go to.
That's interesting. That's the first time I've heard or seen that, and I've been through your model, been through the PowerPoint, been through your website. First time I've heard that phrase. That is quite interesting. Okay. But
the first time you've heard breakneck speed?
No. 18,000 meters.
Yeah, we've done a lot of drilling. So between Jogmec...
Why don't you tell people then? Why don't you tell people?
Well, we used to put those kind of metrics in our press releases, but fine, generally people don't really care about that kind of stuff. And we also track in our spreadsheet, we also track how much drilling every single company that they can disclose, obviously, how much we see in press releases in terms of what is the average amount that a lot of companies drill. We drill a lot, but not all of that it's not around a deposit, it's target testing. So it's over a series of areas in the district.
No, okay, I understand that. So how much money have you spent on drilling then?
So on average, we run around 3 to 4 million. I don't have the exact number in front of me for last year, but I can definitely take a look at that. But on average, we spend about 3 or 4 million on exploration every single year. That's kind of the average run rate.
Okay. And with regards to partner funding, how much have you collected from these 3 last year to this year? What's that worth to you?
Last year, in terms of partner funding, so they sole fund all the programs. So probably about 85% of that would be partner funding. What we do on our own is to generate those projects. So anytime that we spend out in the field doing prospecting, reviewing assets, we may do some sampling programs over areas. Those are all our costs. So on average, we spend about, let's say 1.2 million per year to run the company and the strategy. And as a result, we're constantly replenishing the applications and, kind of growing the portfolio. But the lion's share of the funding does come from partners. Okay.
And what else are you getting out of this? Because, it's fun. When Freeport, you said Freeport, spent a bunch of money, had to go. You own that data. They don't. Is that right? Is that the way it works?
No, when Freeport left, that data is ours. It's actually part of the vehicle that owns the asset, and because we're both shareholders in that vehicle, then both companies own the asset. But in terms of sole funding, they sole fund. So technically, it's their programs, and you obviously it's up to them to determine how much disclosure is provided.
Right. Okay. That's kind of interesting. So it comes back to this thing. I sorry to keep pushing you on this timing thing, but 2021, what are the messages that you're going to get out to the marketplace? Because you got to get people to pay attention. You got to you got a lot of moving parts. You got a lot of land package. You got some nice names in there, and no doubt you'll bring on more big name partners. But what should people be looking for, and what is it that they're not understanding now that you think they need to understand about you?
Well, look, keeping things simple. Again, what we do is we pick up projects, we bring them into the portfolio, we bring on board partners, and then those partners fund those assets and explore. So as I mentioned, we've started exploration on the Vale projects. We anticipate being in a drill program by the end of the year, and that'll obviously continue into the first half of next year. By that time frame, we would also like to bring on board one more partner on the existing projects that are available. And of course, there's the opportunity for the strategic alliance in Bulgaria to bring into fruition the other projects that have already been applied for. The problem is you don't really have a lot of control as a company in terms of how quickly the governments will grant applications. That is definitely a moving target in these jurisdictions. And again, another reason why we have a portfolio approach. But generally, those things are lined up for the next 12 months.
Okay. But you can understand the frustration in the marketplace?
I think that the marketplace needs to understand how the generator model works. And if they accept and understand what they're investing in, then they will be on side with how this type of a business model evolves over time and how it can build value. So I think that you can't invest in a prospect generator or a royalty generator as Monduro is and expect the same type of timelines as investing in a traditional exploration company that goes out, raises capital, drills their resource, tries to, maybe improve their resource report or take their resource into a PEA. That is a very different business model. And as long as the investor understands the differences between them, they can get easily disappointed in an exploration model, but they need to understand what they're investing in. So the generator model that we're pursuing is a long-term business model. It creates value over time, and you really have to have a very competent team that understands how to control that process over the time frame, manage the risks over the long term, and if everybody's doing their job and you get a little bit of luck, then you've got a fantastic opportunity in terms of a discovery.
Brilliant. So, appreciate your time. Thank you very much.
You're welcome.